Joining us now is John Lipsky. He is the National Bureau of Economic Research Director. It's great to have you on, and I do want to start right there with your reaction to those comments we got from the Fed chair, which don't sound that different from what we've heard from him in the past, but perhaps coming off of the FOMC press conference, being taken by the market, at least today, is slightly more hawkish again.
Seems to me that it was quite predictable what he would say. At this point, the outlook for inflation remains uncertain. And in the past, the Fed and other forecasters haven't had a very good record recently in anticipating the twists and turns of inflation. And so the chairman clearly wants to emphasize that the Fed remains fixed on achieving its inflation goals and is willing to do whatever it deems necessary. And there's not enough confidence about even the next few months to give a clear discussion about Fed policy, other than to say they will react as appropriately or what they see as appropriate as the data unfolds.
What are you seeing in the data? There's a lot of debate about it right now.
Well, of course, one of the aspects that, there are a number of aspects that have been surprising. The traditional linkage of unemployment to the inflation rate through the so-called Phillips curve hasn't been working for a long time, and yet conventional analysis uses that as a basis. So it's a little hard for the traditional models to anticipate where we are headed. It seemed to me for quite a while that everything, or a lot of things about the economy's performance post-COVID have been rather unique. The rapid run-up inflation and now the decline. I'm optimistic that we're going to get a moderation, and certainly a moderation in growth rates in the economy following the unexpectedly strong third quarter figures. But in general, a relatively moderate growth rate seems to be in store for the next year and plus, and I would expect to see further progress on inflation. Many folks want to say this last mile of getting down to 2% is going to be particularly sticky, but it's not immediately obvious why that's going to be the case. We'll see.
Sounds like you're in the soft landing camp, which raises the question, is this tightening cycle and what it will mean for the economy and the fight against inflation actually different than what we've seen during previous comparable cycles? Or is it just that it's taking more time? It sounds like, based on what you're saying, that maybe it is different.
Well, the run-up was rather sharp. The run-up in inflation was sharp and unexpected. And you'll notice that a bit of the chairman's speech today was devoted to noting that whereas the Fed took a while to figure this out, so did everybody else. Now they're being cautious about their optimism about what it will take to bring inflation down. What's not completely clear is exactly the linkage between Fed policy and the actual performance of inflation. After all, for many years in the decade before COVID, the inflation rate persistently was below the Fed's target. I'm trying to suggest that there's a lot of play between Fed policy and what actually happens. And it seems to me that the most likely outlook for the economy is going to continue to be disinflationary, but there are obviously risks.